Welcome back everyone. Thank you so much for joining me. Thank you for being here in my channel. We need to discuss very important development in Russia's banking system because the latest numbers are quite telling. In January 2026, Russian households withdraw about 1.6 trillion rubles from bank cards in Russia and savings accounts. That was the second largest outflow in record, behind only March 2022. At the same time, only 468 billion rubles went back into term deposits. So the question is very simple. Where is the rest of the money going? Now let's be clear. This doesn't automatically mean that there is some kind of banking panic now. Part of this move is seasonal. December is usually strong because of bonuses, yield-end payments and social transfers, while January tends to bring heavier spending. But the scale here is still significant. 1.6 trillion rubles withdrawal is not a small number, and when it's less than one-third of the money returns to deposit, that tells you something is changing in household behavior. In other words, this is not just about people spending holiday money. It also looks like a broader relocation of savings. Some money likely went into consumptions, some likely went into cash, some may have moved into property or investment products in Russia. And that matters because it suggests that households are no longer treating bank deposits of the obvious default destination for their money. So what does this mean? It means confidence in high deposit returns may already fading. When people believe peak rates are behind them, they start moving money differently. They become more selective. They look for flexibility. They look for yield elsewhere. And if this trend continues, it could become one of the more important financial signals in Russia over the next several months. Not because the banking system is collapsing now, no, but because household capital is beginning to move in a different direction. We need to talk about the ruble, because the latest move in the currency market is starting to raise a very important question. On March 17, the United States dollar moved above 82 rubles for the first time since December 2025, while the euro climbed about 93 rubles. And now officials in Russia are openly saying that both the dollar and the euro could reach 100 rubles by the end of this year. Now let's be very clear. The message from Moscow is that this is not expected to happen within the next few weeks. According to State Duma Deputy Artem Kiryanov, neither the dollar nor the euro is likely to hit the physiological 100 ruble mark by the end of the March. But by the end of 2026, that level is seen as entirely possible. And that matters because once officials become publicity discussing triple-digit exchange rates, they are effectively preparing to the public for a weaker ruble now in Russia. In other words, this is not just about one trading session, it's about direction. Kiryanov also argued that a dollar at 100 rubles would actually be more comfortable for Russia's export sectors and for domestic producers. That is a very telling statement, because it suggests that a weaker ruble is not necessarily being viewed as a problem by parts of the political establishment. It may actually be seen as useful under current conditions. So what does this mean? It means the market may be entering a period where a gradual ruble weakening becomes the base case rather than the expectation. Economists cited by Gazeta already expect further dollar appreciation with forecasts of 80 to 87 rubles by May, and they don't rule out 100 rubles under a negative scenario. So the real issue now is not whether ruble can weaken. It already is. The real issue is how fast that weakening continues and whether Russian households and businesses are ready for that comes next. We need to talk about Russia's housing market, because the latest mortgage numbers are quite shocking. Right now, if a Russian wants to buy a new one-bedroom apartment with a regular market rate mortgages, the recurrent income is far beyond what most households can realistically earn now in Russia. Let's be very clear. In Moscow, a single borrower now needs a monthly salary about 575,000 rubles to qualify for such mortgages. In St. Petersburg, the number is about 275,000 rubles, and across Russia, on average, it's around 200,000 rubles. That is not affordable housing in Russia. That is a product for upper income borrowers. Now, why are the numbers so extreme now? Because prices are still very high and mortgage rates are still punishing. According to the estimates in the report, if you take a standard market mortgages at 20% interest for 30 years with a 20% down payment, the monthly payment on a typically one-bedroom apartment will be roughly 360,000 rubles in Moscow, 165,000 in St. Petersburg, and 120,000 across Russia on average. And since banks usually want debt payments to stay below about 60% of income, the salary threshold immediately becomes absurd for most people in Russia. In other words, the market is sending a very simple message. Yes, mortgage affordability has improved somewhere from early 2025, when rates were even worse. But that doesn't change the bigger picture. Market rate mortgages in Russia are still effectively restrictive for the mass buyer. Unless rates fall much faster or incomes rise much more sharply, buying even a basic new one-room apartment will remain out of reach for a very large share of the population in Russia. And now we need to talk about Russia's mortgages market, because the latest data is sending a very uncomfortable signal now. By the end of 2025, Russians had started selling mortgage apartments twice as often in order to close their housing loans. In the fourth quarter alone, mortgages worth 425 million rubles were repaid through the sale of pledged housing. For the full year, that figure reached 1.3 billion rubles. Now let's be very clear. This is not yet some kind of nationwide mortgage collapse now. Even the central bank says this is not a mass phenomenon and partly links the number to several large borrowers. But the trend still matters. Because when people start selling the very property they bought with the borrowed money just to get out of the loan, that tells you financial pressure is building. It tells you that for some households keeping the apartment is no longer realistic. And there is another part of this story that is even more revealing. In the fourth quarter on 2025, the volume of mortgages closed by handling the collateral directly back to the bank rose to 757 million rubles. As a result, the total volume of loans closed with the loss of housing reached nearly 1.2 billion rubles. And now quoted in the reports say this likely connected to the 2023 wave of mortgages, when banks were issuing loans with very small down payment to borrowers who already had high debt burdens and were borrowing at market rates. By the end of 2026, problem mortgage debts in Russia had doubled in 205 billion rubles. So what does this mean? It means the stress is no longer theoretical. It's now showing up the borrower behavior. Some people are clearly deciding that it makes more sense to sell now, repay the bank and protect what is left for the finance that no keep falling deeper into penalties, arrears and damaged credit story. This is not a yet full-scale mortgage crisis. This is absolutely a warning sign that it suggests that the weaker part of Russia's mortgage market is starting to crack.